Welcome to Prosperon's Grow Your Balance podcast, where we discuss pressing topics in personal finance and explore the balance between managing your finances and finding your ideal lifestyle. I'm Kyle Trush, and each month I'll be joined by my co-host, Ben Brosnahan, and experts in the personal finance space to help you master your money and live your best life. Because those two things don't always get along. Let's get started.
Bills hit fast, peace takes time. Learn the hard way, now we climb. First check hit, felt rich for a day. Then rent showed up and took it away. Bills hit fast, peace takes time. Learn the hard way, now we climb. Tired of guessing, done with the doubt. You found your crew, we're gonna figure it out.
All right, welcome back to Grow Your Balance. We have a really cool topic for you today, especially with all this volatility that's going on in the markets, and you've heard all of these terms about tariffs, and it's all kind of causing the economy to go awry in a lot of ways. So we're here to break that down for you and talk a little bit about how that impacts your personal finances, how to help you navigate that. And we also are joined later on by Ethan Jiang, who is an assistant professor of finance at Western New England University, and he provides some fantastic insights on how to view some of this economic volatility and handle some of the tariffs and everything like that. It really awesome conversation. And so to kind of jump into things, Ben, what are some of the financial habits you're adjusting given the economic volatility right now?
Yeah, I would say the big thing is while my spending has remained about the same, about not too changed, what I've really adjusted is my savings. So whenever I spend less, I definitely try and make sure that my savings are a bit more padded, and I've definitely allocated more towards my savings as opposed to perhaps investing, just because even though I'm still investing consistently and I still believe investing when it's not necessarily the best economic conditions, I also just really want to make sure that if anything bad were to happen, or no matter what's going on in the economy, I'm very prepared and I have just sort of an extra boost if I need.
Yeah, I think too, just given the volatility with inflation, with these pending tariffs and everything that's going on too, there's almost a necessity to tighten up a little bit and save a little bit more. But I think you hit on something really interesting there, which is if you're building these habits, regardless of what the macroeconomic conditions are around you, that these habits, these I'm still saving, I'm still investing, are really, really important, even when you do kind of need to tighten things up a little bit.
Yeah, just because you're saving more or just because the economy is in a downturn doesn't mean that all your goals or your financial purposes go out the window. It's just that maybe for a short period of time they need to be less focused on relative to making sure that you have financial security, and also just making sure that you keep those in mind. But just I would say it's more like financial prioritization. Like when you have a ton of high interest debt, be it a credit card, maybe your first priority shouldn't be investing all your cash in the S&P 500. It should be paying down that high interest debt. And it's the same with economic volatility. You need to ensure financial security before you go all out on cryptocurrency investments or what have you.
I love that term, the financial prioritization. I think that's just a great sort of synopsis of probably our best piece of advice when it comes to navigating some of these things, is that it's not necessarily that you have to change everything. Like, oh my God, eggs cost $2 more. What am I going to do with myself? But it's more of hey, how do we prioritize our goals, are really lofty goals versus those that are kind of more right in front of us too. And I think it's a really important point, is that prioritization piece for sure.
Yeah, and with that, I mean, there's always stuff that you have to prioritize and perhaps change when it comes to volatility. But are you doing, Kyle, anything just a bit more consistently, like something that when you look at volatility, you're like, okay, this is something that I definitely do not want to change?
Yeah, I think there's certain lifestyle preferences that everybody has, that it brings you happiness and brings you joy, and I think that's one of the things that we kind of dive into in our conversation with Ethan is that, yes, these macroeconomic trends have, can impact your lifestyle and some of your choices. Like you might not be able to take all those vacations you want to take or make those big purchases you want to make, but the things that I'm not changing are more those day-to-day lifestyle things. Like, I'm still, if you're still wanting to invest in your health and you want to keep your gym membership and you want to keep playing in that pickup league or something like that, those aren't necessarily expenses that need to come off the books to help you save a couple bucks when when inflation is a little bit higher, or when things are just a little bit more expensive. I think those are the things that you should kind of hold sacred, like those lifestyle preferences that make you happy, that bring you joy. That if you protect those things and then find the other wants, maybe more like the wants and like the nice to haves, and find those things to kind of cut back on to give yourself a little bit of breathing room, then that's okay. But I think really keeping sacred those things that are part of your lifestyle that make you really happy is really important, even regardless of this economic uncertainty. But curious, anything that you're not changing?
Yeah, I mean, that's a really good point, and it goes a little bit into my answer, but it's similar to that notion of financial prioritization about what to do and what not to do. I mean, it just, when you've got these things in your life that add value to it, even if it's not necessarily monetary value, but such as going to that pickup league, what have you, that that's what makes your day, that's what makes you feel better, then that doesn't necessarily need to be removed. And at Prosperon, what we're trying to do is make these ideas that seem perhaps boring or not engaging or maybe even a bit like pessimistic or remove the joy out of spending. We actually want to shift that perspective towards these activities such as budgeting and saving actually enable you to engage in what you love more consistently. And so if you're able to just prioritize whatever those like select things are that really actually add value to your life, be it the pickup league or going out to dinner with friends, but then removing those other things that really aren't as much of a priority for you. So if you love the pickup league, then maybe going out to dinner with friends isn't as much of a priority for you. Maybe cut back there, save a bit on spending there. What I've been doing in keeping consistent, I really want to invest consistently, honestly, because being young, I know that time and compound interest are really working in my favor right now. And so even though I'm investing about 15% of my income, which at my age right now is not a ton, I'm still doing it consistently because one, when my income does rise, investing 15% of my income will actually be a lot more meaningful, at least to me, from a quantity standpoint. But then also, if I just continue to invest consistently, uh, whether the economy is down, I'll be getting more shares, I guess, for each stock that I buy. And when it's up, I'll be buying less. And so my investments even out, and hopefully that helps my growth over the long term.
Absolutely. I want to kind of shift back to something that you mentioned briefly, which is like that budgeting and savings, those types of habits, and I think those are really important things to think about when we're considering how to almost like volatility proof our personal finances. And so, what are some, in addition to, or even kind of expanding on that budgeting and savings as those two ways to volatility proof your personal finances? How do you do those types of things to help you navigate, economic uncertainty and keep yourself personally financially stable?
Yeah, I mean, as our listeners will hear in just a few minutes as we talk to Ethan, one of the most crucial, let's say, pieces or muscles in your financial portfolio is your emergency fund. And that is definitely one of those things that isn't sexy. It's not like investing or maybe travel rewards from credit cards, but I mean, the benefits that come from having a solid emergency fund are sexy. And the reason I say that is just because if you, the way I think of an emergency fund is it just answers that question of like, what would happen if, and that's if you lose your job. What would happen if you lose your job? Oh, your emergency fund can cover you until you find a new one. What would happen if the car breaks down, oh, well, you won't have to use a credit card loan in order to pay off whatever repair you need. You have that emergency fund. What would happen if the house explodes, etc.? Hopefully, none of these things happen. Hopefully, you don't have any emergencies, but having that emergency fund gives you the freedom to know that if you decide to take that day off work, or if you decide to go on vacation or buy that big thing, and then like misfortune strikes, you're prepared. And that is like the greatest level of security that you can ask for in your finances.
Yeah, it's so such a good point that it's emergency fund isn't like the most sexy personal finance topic out there, but when you think about it in terms of its ability to protect you from this economic volatility and even just the things that happen in life, it's so important. It's like buying insurance. Like nobody
Yeah.
loves paying for insurance every month, but you really love it when you get in that fender bender, or you get sick and you have to go to the doctor. Then we're like, oh, love insurance. But emergency fund's the same way. It's you're tucking away this money fairly consistently. I would say probably depending on your income, anywhere from like $1,000 to $3,000 is probably a healthy emergency fund. Again, depending on your lifestyle, the things you might foresee happening, it can be more, it can sometimes even be less, but you're really kind of creating this cushion for yourself allows you the freedom that when this economic volatility kind of hits, and if these tariffs do sort of come to fruition and we do see a lot of increased prices on everyday goods, that that you have this thing that's this sort of safety net behind you in case you need to tap into that. So but kind of shifting gears here a little bit, you also mentioned investing and some of the things that you're doing, investing wise throughout this economic volatility. So, for those who invest, is there anything they should consider or do differently given all this volatility?
The short answer I would say is honestly no, but just to make things a bit more exciting and also to go more in depth onto that, when you think about the way that you invest, it should assume that there will be market volatility and there will be downturns in the economy. When you invest, it is tends to grow, and over the last 50 years, it's on average grown about 10%, which is good. But that's over the last 50 years, and that's on average. What happened in 08, 09, there was a huge downturn. So yeah, that was during the last 50 years, and yeah, over average period of time it goes up, but there are downturns and significant ones at that. And so your investment strategy shouldn't assume or only exist when the market is going up. It should, that strategy should take into account that things are not going to go your way all the time. That said, if you're really like, perhaps if you've got some fringe investments that are going to be uniquely affected by the tariffs, then maybe that changes things for you. But the investing that I tend to do is in indexes, and they're very diversified. So it's like the S&P 500, top 500 stocks in the US. Now that is a bit more tech focused, and so maybe I should be a bit more aware of how tech is being impacted by tariffs. But overall, my investment strategy assumes that things aren't always going to be great in the stock market, and little actually changes when that comes to fruition.
Yeah, and I mean, it's something that we preach at Prosperon, and a lot of our content that's focused around investing is creating a balanced portfolio. It's not, if you're completely invested in like only stocks, then this type of volatility is going to really hurt because you're going to see a lot of those things fluctuate pretty dramatically, with hanging on basically any word or information that makes its way out to the public. Versus if you diversify your portfolio and you're balanced in some stocks and some bonds and some mutual funds and ETFs and index funds, things like that, where you're really creating, taking your risk and spreading it out across a bunch of different types of investments and securities. So I think that's one thing that we definitely preach here at Prosperon. And if you want to learn more about it, we have plenty of content on investing and creating a balanced portfolio. But I also think one thing that you guys mentioned, and it's kind of a spoiler alert for the interview in a second, but one of the things that you guys always said in that interview was, time in market is better than timing the market, and that, having a consistent investment strategy and consistent investing habits versus like really trying to time things out perfectly is going to be so much better. So if you can build these healthy habits of, I have a diversified portfolio, I've committed to maintaining a consistent investment strategy, then you're going to be much better off than somebody who's like trying to play the volatility game and like, oh, the stock dipped a little bit today, I'm going to go in and buy it today, kind of thing. So I think that's also a really important note when it comes to investing during volatility.
Definitely. I have a lot of people that when I first talk about investing, they're like, well, I don't have the time to research the perfect stock and I don't know when I should invest. And there's two big issues with that. The first is uh, if you're investing in diversified index funds or if a lot of the recommendations around investing don't say that you should really be spending all your spare time with your nose in a book or a podcast trying to find the perfect stock that's going to go to the moon because one, that's extremely rare. While there's Facebook and Microsoft and Apple, there have been thousands, if not millions, of other companies that perhaps were going to go to the moon, but things just didn't quite work out. So finding that perfect stock is incredibly difficult. And then on top of that, one thing that I forgot to mention earlier is just that as a college student, I am young. And what that lends towards me is that I have the time with my investments that if I invest and they grow for a bit, but then they decline for a while that's really hard to watch, I'll be honest, like the emotions hurt. I also have the comfort of knowing that I have another 10, 20, 30-year time frame, 40-year time frame for my investments to recover and grow because the market does tend to grow over time. And so I don't focus at all, I think, on making sure that I get my money in at the perfect right time in the market because what my investments are intending to do for me is build financial freedom. They are not another way for me to spend my time focusing on my money. My financial systems are meant to free my time and make me feel financially secure. And timing the perfect investment and thinking about when I should be buying this stock is not part of that. So,
Man, we are just full of like flashy and sexy financial advice today. Consistency and patience. That
you
is the
know
key
it. You know
here.
it. Gets me
All
crazy.
right. So with that, why don't we jump into our interview with Ethan, and we'll catch you on the other side. Before we jump into our interview with Ethan, I want to take a moment to talk about what's going on at Prosperon. Whether you're new to the brand or a friend of the program, we're excited that you're here to learn more about elevating your personal finance mindset and exploring ways to balance your financial management with your lifestyle. Visit us at prosperon.io, that's prosperon.io, to check out what we're up to. In addition to this podcast, we're also going to be rolling out some exciting new content in the near future that you won't want to miss. What's that? You want to make sure that you don't miss these exciting updates? Well, boy, do I have something for you. Sign up for our newsletter. When you visit prosperon.io, again, that's prosperon.io, click on the About Us tab to sign up for the newsletter and be the first to know about our new content updates, product launches, and more. Now, let's get to our interview with Ethan. All right, so we are joined by Ethan, who is an expert in all things sort of economics, finance. You're a professor at Western New England, very active in the finance space as well, and we're really excited to get your perspective on all the economic volatility that's going on right now and how that might impact people's personal finances. So first and foremost, welcome.
All right, very excited to be here. Thanks for having me.
Absolutely. So, I mean, to jump right into things, those tariff announcements in early April and really all the trade policy adjustments that followed, you triggered a lot of economic volatility. And so, based on your interpretation of where things are at with that situation and where it's going, what potential impacts do you see that having on people's personal finances?
Sure. So if you think about the last time that this trade war or tariff happened between U.S. and China, it was back in 2018. So in that time, the trade war started in January 2018, got escalated a little bit in 2019, and finally the two sides come into a phase one agreement in early 2020. So it takes almost 2 years for this thing to sort of goes away. So in this time, I believe that the two sides will eventually reach some sort of agreement. The question is, how long would it take for that to happen? And until that happens, so we will for sure see higher price levels as a whole, because really the way you should think about this tariff is it's really some sort of a non-progressive tax, which makes everything more expensive for everybody. Um, Therefore, if the wages do not go up proportionally with the prices, then that means the inflation is gonna reduce or the purchasing power, so which create more pressures on creating a budget. Therefore, I think from a personal finance perspective, we really have to think about how to manage our budget more effectively to deal with the economic uncertainty caused by the tariffs.
I totally agree. I think one of the things that I've discussed a lot of the oncoming and probably already felt impacts with the tariffs. And when you say non-progressive tax, where what I try to tell people is it's going to hit prices and it's not going to hit prices differently for whether you make higher income or lower income. It's just across the board.
Exactly,
You're going to see
exactly.
issues with taxes. And then on top of that, this is not it definitely compounds inflation, but it moves things so quickly that yeah, your wages are probably not going to adjust, and
Right.
you're probably going to have to adjust much
Yeah,
quicker.
exactly. So economy, they always think that at least in the short term, the wages are kind of sticky, right? So you probably won't get a raise until probably you have to wait a year for another contract come in for your employer to adjust your wages. But the prices that you're paying on stuff, they change on a much higher frequency. Every time you go to Costco, go to supermarket, you will feel it, continuously.
Yeah, so the dollar is just same amount that you make is just not going to go as far, and that's going to change the way that we live life. With that in mind, do you have any recommendations or do you have things that you tell your students given the uncertainty about how they can work around that or what they should be thinking about given that their dollar might not go as far?
Sure. So from a like an expenditure consumption perspectives, so I would always tell my student that. So I basically tell them two or three different things. The first one is if you have any large purchases that you plan to make in the near future, think about if you can sort of smooth out the consumption over time. Because as I mentioned before, I think this tariff will eventually go away. Probably going to take 6 months, probably going to take a year. Therefore, if you can delay the large purchases, then the higher price is going to have a smaller impact on you financially. This is the most important thing that I told my students. And the second one is I would also sort of recommend them to shop around because and also try to substitute the imported goods with their domestic counterpart, because remember, so tariff is basically a tax only on the imported stuff, right? If you can find a domestic product which is otherwise similar, then of course the tariff will have less impact on you. And then always shop around, because in this case, the importers are paying the tariffs, which will clearly squeeze their profit margin. And then, different sellers, they have a different profit margin, which means that some sellers will be able to lower the price or increase the price to a lesser extent compared to others. So never stop shopping around.
I fully agree. I mean, even under non-tariff conditions, I'm always
Yeah.
telling people, do your research, shop around, look into alternatives. That said, for some people, the ability to put off whatever this large purchase may be, say a car,
Right.
might not be as feasible. It might not be as easy for those individuals who maybe need to make a large purchase and do it in the next 6 months to a year. Do you recommend, or would you say perhaps do it sooner? Because I have heard a lot of people are like, there's been news about people putting in car purchases right now before they rise because they're set to rise, perhaps, I mean, multiple thousands of dollars. What are your thoughts around that?
So here, okay, I think that's a really good point. Because what you're recommending is if you believe that the price is going to increase further, then maybe you want to sort of take advantage of the lower price right now before it increases further. So that, of course, here I think you have to look at two things. The first one is, so first of all, prices, they will never go down unless you have deflation, right? So when we talk about this inflation, we're really thinking about how fast would price increase over time, right? But the price rarely goes down. Therefore, you know, buy the stuff today compared to 3 months or 6 months from now, right? You're always paying a lower price, of course. Therefore, if for the type of purchases that you couldn't delay, definitely make the purchase right now. But I would be very cautious on forecasting the price level 6 months from now, because that, of course, depending on, the decision of the Fed and other factors, which have a lot of uncertainty as of right now. So I would not, dwell too much on forecasting the price level for the next 6 months, because I feel like there's too much uncertainty. Instead, you should base your decision on whether you really need the items right now or not.
Yeah, it's such an important point too with personal finance is that decision making aspect that yes, there's a degree of research you can do today that can help you be more informed about what's coming down the line 3 to 6 months from now, but ultimately when you're factoring in that decision, all the different aspects of what do I buy now versus what do I buy later, I think that's an important thing to think about, is that if maybe you're not the biggest personal finance expert and you're sitting here listening to this and you're like, I mean, I could try to forecast 6 months from now. It's probably just not likely that you're going to be able to do that super accurately. So you really have to think about those other parts of that decision making
Exactly.
process.
Yeah, I couldn't agree more. So, I came from, my background is quantitative economics. So when I was working on my PhD, I did a lot of quantitative exercise in forecasting. I deal with those time series data a lot, trying to, refine the forecasting method. So I can tell you from experience that forecasting is pretty hard. But forecasting in today's challenging environment with a lot of uncertainty is almost nearly impossible. If you talk with, say, fund managers from Wall Street, you're asking them, how would you adjust your portfolio based on today's challenging environment? Some of them would just say, okay, we will just hold a steady portfolio because today's trading environment is too volatile. We couldn't afford making mistakes. We couldn't afford betting on the wrong direction. So, they just, don't overweight anything, don't underweight anything. Everything as normal. Okay, that's how they navigate through this challenging environment.
Yeah, and I think that hits on a very important point that I try to bring up to people, especially during the economic downturns or economic volatility, is that you should probably do as the hedge funds are doing in a certain way, which is stay consistent, stay the course. Don't necessarily switch up your whole strategy just
Yeah.
because stocks are down or there's economic
Yeah.
volatility, because your investment plan and the way that you plan your finances should involve an assumption or the prediction that the economy will not always be up. And so that doesn't mean you should stop investing, and that doesn't mean that you should pull all your money out of the stock market and hide it under your mattress. Which means that things are going to get tighter for a little bit, and perhaps you should save up a bit more cash.
Exactly.
Yeah, which I think also leads to a really interesting point, Ben, about when you kind of mentioned like saving up your cash, like that importance of that emergency savings account as well, and that when you're planning for your financial future, or even just kind of navigating the ups and downs of your personal finances on a daily basis, that the importance of having that emergency savings account, and that you're stashing a little bit of money away from each paycheck, trying to build this account up so that when there is economic volatility, and maybe going back to some of those decision making processes too, that you need to make some of these shorter term decisions, but not sure how things are going to play out longer term, that you do sort of have this cushion. So, I think that's a really good reason to establish an emergency savings account, as well as also know when to tap into it. I think that's a really important note too, is that, when you're experiencing this kind of economic volatility and you're trying to figure out how to navigate the next 3 to 6 months without having a very clear forecast, that occasionally you might have these instances where you do need to tap into that. And that's something that we definitely preach here at Prosper on, but also just something that's really important to keep in mind in general.
Yeah, I fully agree. Just because, you know, I won't get too much into the categorization and stuff, but people sort of sometimes will feel guilty when they tap into their emergency savings, so they don't know when they should. And the simple rule to me is, if it's a necessary expense. An emergency savings fund is not when you figure out that there's actually a few more Bad Bunny tickets and oh my gosh, you need to be able to cover those. It's like if the car breaks down, if the economy's tumbling and suddenly you don't have enough money to cover rent, stuff like that. It's for the necessary expenses. But with that, also when it comes to the volatility side of things and things getting tighter, uh, staying the course and just making sure that it's easier to have this emergency fund ahead of time and not have to come up with it in the moment. So uh, I would sort of pitch that question towards Ethan for your students that may be perhaps a little bit behind or not used to the economic volatility, or maybe they're out of their home and having to take care of their finances a bit more. What would you say they should be sort of prioritizing first and foremost, or thinking about given the situation?
So what the student need to think about first and foremost, in terms of investing or
I mean, investing or personal finances.
sure.
I would your preference on that one.
Sure. Okay, sure. So, I think what young adults need to know is this. So, given today's challenging economic environment, right, there's definitely a lot of uncertainties, but, creating a emergency fund or budgeting this is their best defense against that uncertainty, because this is something that they can indeed control themselves. Right. So I think by that, I mean, every time they receive their paycheck, especially during the challenging economic environment, they should probably think about to first and foremost to put aside a portion of their paycheck to their emergency fund. That will create as Ben just mentioned, create a buffer against any uncertainty, because as we all know, so if this tariff really leads to a recession, then that means unemployment rate would go up. Some people would lose jobs, unfortunately, and it may come to them. Right. That makes this emergency fund especially more important in this challenging situation. So I would advise them to allocating a higher proportion of their paycheck to the emergency fund. That's number one. And I think we also talk about this a little bit. So they shouldn't stop investing, because I mean, I don't really mean encouraging them to buy the dip or something like that, but instead, they should consistently put a small amount of investment into a stable investment, for example, like an index fund or something, right? Because if you keep investing, right, you're going to, over time, you're basically lowering your cost, the cost of your portfolio. Then if you sort of zoom out and look at the bigger picture, 3 years, 5 years from now, okay, this is actually a good investment as long as you can navigate through this economic uncertainty, right? So these would be the two things that I advise my student to do. The first one is to thinking about to increase their emergency fund to prepare for any uncertainty, especially if you got laid off or anything like that, to prepare for those job market friction. And then the second one is do not stop investing.
Yeah, I love that point, and especially that quote of like your emergency fund or your budget, like that is the best defense against
Yeah.
uncertainty. I think that's such an important point. And then when you're kind of zeroing in on investing too, like understanding that diversification is a huge piece of this as well. That it's one of the best ways to certainly guard against uncertainty and volatility because you diversify your risk across a bunch of different
Right.
securities and investments, things like that. So, can you speak to the importance of that diversification a little bit, and especially when there's uncertainty in the economy?
Sure. So there are actually two types of diversification strategies. The first one is you do not put all of your eggs in one basket. You invest across different sectors. So I call this the cross-sectional diversification. Right. In this case, you're basically make your investment portfolio immune to the firm level idiosyncratic risk. Right. So for example, if the CEO of a company had a car accident because that company only has a very small weight on your portfolio, then it wouldn't impact your overall portfolio by a lot. This is what I call the cross-sectional diversification. But what we're dealing with right now is what economists call a systematic risk. For example, like tariff, anything related to the macroeconomy, in which all stocks are being affected. So we call that a systematic risk. So even if you invest in, for example, 1,000 companies, because they're all part of a aggregate market, then every firm will be affected. So cross-sectional diversification would not work well if we have systematic risk as we have right now. So in that case, what I recommend is I call you diversify your investment over time, meaning that you don't put all of your money in today or tomorrow, but instead you gradually started to invest in the stock market. So in this case, you're sort of diversify away the risk along the time dimension. I think a couple of weeks ago, so I came across a figure which is really interesting. So that figure shows you your investment return from the last 20 years, from I think 2003 to 2022. So they have it's basically a bar chart. So the first chart is show you your investment return if you just all in 2003, and then you just buy and hold across 20 years, in which I think you have like like a I can't remember. I think it was 60 times return or something if you don't sell any of your stocks. But then the second one right after that is if you miss the 5 best trading days in this 20 years, which is really a small fraction, right? So, 20 years, this is 20 times 250, that's 5,000 trading days. If you only miss 5 best trading days, then your total investment return actually decreased by half. If you only miss the first 5. And then if you miss the 10, then you would decrease by a lot. So this speaks to the importance of, or speak to the danger of timing the market, right? If you sell the stock at a wrong time, or if you didn't in the market in the right time, then you actually pay a huge price for that. And if you diversify over time, okay, you gradually invest in the market, then this is the best way to avoid missing the good times.
Yeah, I think the term that I often hear to describe that sort of time diversification is dollar cost averaging.
Yeah,
And
yeah,
the way I think about dollar cost averaging is that you're just putting the same amount of money in, whether it's a percentage of your income or it's a set amount for a like fixed amount of time, fixed ratio,
yeah,
fixed interval. So what that means is a lot of people that I meet that are young and just thinking about starting investing or have just started investing, they don't think that they should invest until they have a large amount of money or a large sum to put in, or they just don't think they have enough money to put in. And I honestly often think about dollar cost averaging as very antithetical to that, simply because you don't, if even if you have, say, $1,000 that you can put into the stock market right now, yes, that's good. Like, you should be investing, but it's actually perhaps better to invest $50 a week or $200 a month and just continuously invest consistently. And then even if the stock market, even if a tariff hits and the stock market's down 10%, 15%, 20%, continuously investing that $50 a week and $200 a month, etc., just so that on those really bad days, yeah, maybe your value of your investment dips a bit, but if you do it consistently, you're not going to miss out on those highs. You're not going to miss out on those live trading days that make twice.
Exactly.
And
Exactly.
that's
Yeah.
important. Time in the market is what they say always beats timing the market.
Right. Yeah. I think it was Warren Buffett who said that time in the market is more important than timing the market. Right. If you think about, your 401k, that's exactly the same principle, right? Every time you receive a paycheck, you put, 4%, 5%, into your 401k account. And then, you don't worry about it anymore. You just do it consistently. And then over time, you're going to accumulate a return which will surprise yourself.
Yeah. So with that, you don't even need to start with a huge sum of money in order to get investing. Just
Yeah.
consistently and do it over the long term, and don't stop just because something in the macroeconomy changes, because your reason for investing shouldn't change.
Yeah. Yeah. I think it was like a month ago, maybe 2 weeks ago, even my wife asked me, oh, the market was so bad these days. Should I stop the 401k contribution? I'm like, no, never, never.
No.
That's the point of 401k, is that you just make a fixed amount of investment, periodically, and then don't worry about it. I'm sure, in a couple of months, maybe a year, we'll be out of this.
Great. So, as we start to wrap this up, last question here. If this economic volatility keeps up for the next 6 to even 12 months, how should people be adjusting their financial goals or their budget to maintain that personal financial stability?
Sure. First and foremost, I think at a high level, I think especially the young adults, they should be thinking about how to adjust the proportion of going into their emergency fund versus day-to-day spending and versus investment. I think this is really important. As I mentioned a minute ago, maybe they should think about increase their emergency fund to the extent that they can, and think about to delay their large purchases so that they have more money to be allocated to the investment account. I think that this is from like a high level approach, thinking about how to allocate your money. And more specifically, I think this year the investment environment will be very challenging. So I wouldn't be surprised that you will see a loss on your investment account. So more specifically, if that happened, right, then a lot of people, they would have to sell their stocks at a loss. So if that happens, make sure that you're aware of the so-called wash sell, because which means that before or after you sell at a loss 30 days, there's a 30-day, before and after, that's a 60 window. Don't buy the stock back. Otherwise, you will not be able to deduct the loss when you file your tax return. So, I think like 2-3 years ago, I didn't know this myself. So I think it was in 2022, the market was doing very horrible. But when I filed my tax return, I'm like, oh, how come I still have a net gain in my investment account? And then I look at the transaction, see a lot of these, sell on at loss, what was marked as watch sell. Okay, so this is a small detail that especially young adults needs to be pay attention to, because otherwise then you will not be able to deduct those losses from your tax return.
That is a fantastic point, and I think overall just a great message too for young adults or for anyone really that as you encounter some of this volatility, that
Yeah,
there's just
this
some
is
simple
indeed like
strategies.
the lesson that I myself learned in a hard way, right? Because
Yeah,
normally we wouldn't like pay attention to this, but that's why I think it's worth to sort of point it out.
yeah, absolutely. And I think it's so funny. Sometimes those mistakes that we make are the ones that hopefully we can help others learn from.
Yeah, yeah.
So this was a fantastic conversation. I think we covered a lot of ground when it comes to navigating some of the economic volatility that you're going to see over the next year or so. And so, hopefully there's some great, pieces of information there to help navigate all of this. So, Ethan, thank you so much for coming on. This was again an awesome conversation.
Hey,
So thank you so much for being here.
thank you so much. Okay, glad to be here. Thank you. Nice to meet you
Awesome.
guys.
Nice to meet you as
Take
well.
care.
All right. So a lot of takeaways from that conversation with Ethan. I think one of the things that kind of stuck with me the most is that we talked a lot about some of those financial habits and how those things change when you're facing this economic uncertainty, especially when with the threat of these tariffs. And so you know, one of the things that stuck with me was just delaying large purchases. And we touched on it at the beginning of the podcast too, where we were talking about how you don't have to change all of your financial habits, but there might be some things that do need to shift. And one of those things might be if you're looking to buy that car or looking to make a large purchase, that maybe you want to wait out some of this volatility to see if the storm passes a little bit before you make that big purchase.
Definitely. I mean, having the financial flexibility to wait on a decision does empower you. And whether that comes to making a car purchase and being able to walk away from a crappy deal, or looking at home interest rates right now and thinking maybe I'll wait for a few years, that can make your life cheaper. It can just make your finances better.
Yeah. I think the other thing that got me was just reinforcing the importance of emergency savings. That having that emergency fund as that cushion. I know we highlighted it a lot at the beginning of the podcast and kind of reinforced that in the interview here, but it kind of is the message here when you're dealing with economic volatility. How do you create that safety net and those habits that help you? I keep using this term weather the storm, but like weather the storm until, because I think the other thing that Ethan mentioned was that a lot of this is cyclical, and you see these peak volatility and then things kind of even out. And so how do you really create that balance and that cushion so that you can navigate that, and an emergency savings account is a great way to do it.
Yeah, I think emergency funds are one of my favorite things in personal finance because they really create a level of security that you can't get from really anything else, I think, when it comes to your money. Now, they also don't need to be like investments as well. You don't need to invest into an emergency fund consistently. You can kind of set it up and then put it in a high yield savings account
Yeah.
and just make sure that it can cover your expenses when it needs to. If you end up spending more or having higher housing costs, then it needs to be adjusted. But really, nothing's going to get you financial security like an emergency fund. But one thing that actually stuck with me a bit more was diversification. Ethan mentioned how you can really diversify across different asset classes such as real estate, investments, bonds, etc. But then also industries. I think you can invest in banking in the financial sector or tech and or energy, etc. And so I think just hammering in that point of making sure that you're not just invested in one stock and you put all your money in Apple, but it might actually be more secure and a safer move to put money in Apple and then Goldman Sachs and then a few like Walmart, and or just use an index fund to get that diversified a lot easier and make your investments a bit more strong.
Yeah, I think too, like when you say the word investment, I think everybody just kind of gravitates towards stocks, maybe even bonds or things like that. But also understanding that your emergency savings, if it's sitting in a high yield savings account, that's a piece in your investment portfolio, and that it's a very volatility proof piece of your investment portfolio. And so when you're thinking about diversifying, understanding that your emergency savings can be a piece of that too.
Yeah, easily. I mean, Wealthfront right now is offering 4% on
Yeah.
high yield savings accounts. So if you got 1 to 2 to 3 or more $1,000 in a high yield savings account, 4% on that, I mean, it's not a huge amount, but $1,000, that's $40 a year. That's not too bad at all.
Yeah, absolutely. Well, so as we wrap things up here, for our listeners, how do you actually stay up to date on these things, these rapid economic changes?
Yeah, I use like just very short form podcasts. I listen to them at the start of my day. I like NPR, so Up First from NPR, Marketplace from NPR is pretty good. But even I will say, as you listen to these podcasts, one of the things that they hammer in as they're talking to experts, as they're talking to just people that know far more than perhaps I will ever know about finances, was just that they say one of the biggest things that they are uncertain on is just that while tariffs may exist one day, there's a bit of volatility about just the existence of these policies, let alone the impacts. And so the impacts are not fully certain. So definitely don't make hard plans assuming that something's going to be a certain way for the rest of time because things are so subject to change so quickly that you really don't know what the policies are going to be and what the full impacts will be.
Yeah, I think anything you can do to immerse yourself in that kind of information from the experts in the field is incredible. Whether that's a podcast, whether that's reading articles, whether that's you really want to dive into some of the research on how some of these things actually work and impact the economy. I think it's really good. I also think it's important to be careful too about when you're hearing all these different viewpoints and all these different pieces of information, not to overreact to any one thing that you hear. That
Agreed.
somebody might be saying, the sky is falling because of these tariffs, but somebody else might be saying, we're going to be okay. This happens. This is cyclical, or this is just sort of a storm that's going to pass. So I think it's important to not to overreact or underreact to anything that you hear out there, to really gather that information from those reliable sources and make informed decisions about your personal finances.
Agreed. Wholeheartedly.
Sweet. All right. Well, that's all we have for you today. If you are curious and want to learn more about everything in the world of personal finances, feel free to visit us at prosperon.io. That is prosperon.io. That's our website. You can find more about the different content that we're putting out there, as well as some of the exciting updates that we have coming down the line. So, Ben, any closing thoughts here?
Take care, people. It's a volatile time. I wish you the best.
All right. Have a good one, guys.